Welcome to Market Catalysts. I'm Brad Smith. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we are watching this hour. First up, we break down geopolitical risks facing investors as global markets await Iran's response to U.S. strikes. Plus, Jerome Powell heading to Capitol Hill. We'll preview what we can expect to hear from the Fed chair on interest rates. And we bring you the latest on the artificial intelligence trade as talent wars heat up in Silicon Valley. All that and much more during today's show. Let's start things off with a check on markets. Dow, S&P 500, and the NASDAQ. U.S. major averages higher across the board fractionally here as we're continuing to track how investors are parsing through the latest details on a tick-by-tick basis coming out in some of the conflict in the Middle East here and the U.S.'s involvement that transpired over the weekend here. We're also checking in on the bond market this morning as we're going to get some more economic data over the course of this week, really looking at inflation. Keep a close eye on the 5, the 10, and the 30-year as some of that eco data trickles through here. As of right now, we are lower across the board, just fractionally as it may be, seeing some downward carrots for the three major yields that we're tracking here, the 5, the 10, and the 30. And then additionally here, we're also tracking oil prices. And we're going to take a beat on this one because oil prices wavering today after spiking on supply disruption concerns as conflict escalates in the Middle East. Yahoo Finance's Inez Foray is here with a closer look at where prices could be headed. Inez, what do we know?
Yeah, Brad, and we saw oil prices spike initially last night as much as 5.7% when it came to Brent, but then they have come down since then. JP Morgan analysts are noting that oil infrastructure in Iran has remained intact. Oil tankers are still going through the Strait of Hormuz, so that is steady, and the outlook will really depend on what Iran does as far as a retaliation move is concerned. Now, the consensus is that there is some limited appetite for a broader conflict. What Iran could do is it could go up, it could target U.S. naval bases, it could also back Houthi attacks on tankers, it could also go after infrastructure in the region, and of course closing off the Strait of Hormuz, and that is where JP Morgan analysts see oil could spike to anywhere between $120 and $130 per barrel. But that is something that is a low probability, according to Wall Street, that they would actually go through with that closure. And JP Morgan analysts also noting that Brent has averaged $67 quarter to date, in line with what their estimates are. And I just also want to point out that President Trump has tweeted over the last 15 minutes, tweeting to the Department of Energy, drill, baby, drill. And I mean now. He has stated numerous times he wants energy prices lower. He does not want to see oil going higher right now.
And as we're going to continue to track some of these fluctuations within oil markets. Thank you so much.
Thank you.
Well, stocks are holding on to narrow gains as investors await a response from Iran after the U.S. preemptively struck 3 nuclear facilities in the country over the weekend. According to a note from Michael J. Wilson at Morgan Stanley out this morning, market response is typically limited following a geopolitical strike. But if Iran's National Security Council follows through on its parliament's votes to close the Strait of Hormuz, the oil prices, they could spike. Joining me now in studio for the show, we've got Jay Woods, Freedom Capital Markets Chief Global Strategist. And for more on geopolitics, we've got Russ Mould, who is the AJ Bell Investment Director. Great to have you both here with us today. Jay, thanks for joining us throughout the show here. As we continue to evaluate some of what we're seeing in the early market reaction, of course, we were seeing this play out in the futures over the weekend after the U.S. struck some of the nuclear facilities in Iran. And then now we're seeing some of the early market action here on the day. Jay, just want to get your evaluation.
Yeah, a little surprised that we're shaking this off. This market continues to climb this wall of worry. And after watching the futures open and seeing oil spike almost 5%, I was flipping back and forth from Phillies Mets to check the futures all night. Waking up to see us kind of calming, and now 9 of 11 sectors up for the year, all 11 up for the day. A little head scratching, but kind of a relief. We're still waiting to see what the reaction is out of Iran, but for the market to shrug this off, I'll be honest, it's a little surprising.
From head scratching into strategy, Russ, I wonder what you're kind of sifting through in terms of the data to really inform what that strategy looks like on today's activity, and then even further looking out into the future if we were to see a prolonged type of conflict and events to play out?
Yeah, I think that's what a lot of people are wondering about, is if we did get a sustained increase or widespread conflict and there were to be, say, escalations, which could lead to a sustained spike in oil, that would be perhaps when the worries about inflation would resurface, starting to put perhaps some pressure on consumer wallets and purses, particularly through the petrol forecourts and energy bills. Again, well, I think perhaps one of the reasons why Jay and I are pleasantly surprised is that we're not seeing that immediate oil spike. So I guess the big worry would be if we got that later. You know, the nightmare scenario would be a return to the 1970s when you saw two big oil price spikes, galloping inflation and interest rates shooting higher. I guess one big difference between now and then is that America is way more self-sufficient in oil and hydrocarbons than it was then. And another is that relations with Saudi Arabia seem to be an awful lot better than they were then. So there are some potential similarities and echoes, but some big differences as well.
You know, just to follow up on that, and there is the question internally here as we've been evaluating here at Yahoo Finance, is whether or not there is just so much of the optimism that investors are really trying to latch onto right now that even when there are very present risks, is there more of kind of this melt up reality that we might see play up regardless? Russ, I'll go to you on that first.
It certainly, if you're a bear, you're having a very, very difficult time of it right now. I think if we'd started the year and you said that we'd walked into, you know, some fairly spiky tariff and trade discussions between the world's largest economy and many of its trading partners, with just one deal done so far, not 200, and we'd walked into, you know, ongoing conflict in Eastern Europe and escalation in the Middle East, I think most people would have been extremely pleasantly surprised to see equity markets where they are. And perhaps less surprised to see gold where it is, but equally pretty stunned that oil perhaps hadn't done more.
Jay, want to pose the same question to you, get your reaction.
Yeah, thank God I'm a technical analyst first and not listening to the fundamental news, because the fundamental news makes you want to bury your head in the sand, and it gets people asking me these questions all the time. Why do we continue to go up? Well, we're not really going up, we're going sideways, we're congesting here. We do have some deadlines. We have the tariff 90-day down the road, remember that? One deal done, as Russ said. We're supposed to have 90 deals in 90 days. That comes to us July 9th. This uncertainty is still there. We had the Fed meet last week, and guess what? The S&P 500 was down 1 point on the day, where the Fed kicked the can down the road to the September meeting for a possible cut, and a lot of dissension from the ranks. So right now, I look for where the leadership is, and that's starting to come back in some of these Mag 7 names, these large cap stocks. Technology's doing well. This is good for cyber. We've seen the defense stocks in the industrial sector do well. So there are pockets of strength, and the pockets right now are some of those large caps that are going to keep this market up. And the breadth overall is pretty solid too. So it is head scratching, but the trends continue to be slowly, steadily climbing up. The dips have been bought. We didn't even get a dip to buy this time, and that's what's surprising to me right now. You
know, it's really interesting, especially the typical flow into the defensive sector, as you were mentioning, Jay, based on what we're seeing on some of those flows, on some of the technical indicators and the data. Are we seeing that play out all over again?
We are seeing, this is something new. This isn't anything I can compare to. I wanted to compare this to Ukraine and Russia, and we get that knee-jerk reaction, which looked like it was about to happen, where we sell off for 2 to 3 weeks. Energy spikes. Energy is kind of stable right now. We're seeing some small breakouts in like Oxy's and Baker Hughes and some of these names, but no, there is no panic. There's no fear in this market, where it was washed out with sentiment levels at historically record lows just a few months ago with this tariff trade. Right now, it's on the verge of a breakout and a FOMO trade if things continue on this path. We'll see.
Russ, assuming tensions start to cool and we do see hopefully some negotiation come to the front, what next after that? Because we still are pushing up, as you mentioned a moment ago, against this deadline for tariffs and the pause expiry there. Are we going to essentially expect that many of these deals or negotiations are just going to get further extended in terms of a deadline that could be pushed back, whether another 45 or another 90 days? What are your anticipations there, and how do investors trade on that?
Yeah, I mean, looking at that here from the UK perspective, we're seeing President Trump teaming still quite a hard line with regard to that 9th of July deadline, but Treasury Secretary Besant take a bit of a softer one, arguing that if any nation was arguing good faith, they could get some extra time. So if I was one of those nations, I'd make sure I was in front of Treasury Secretary Besant and his team saying, I'm negotiating in good faith and buy myself that extra time. So we may get some delays. I believe also there still is that Court of Appeal decision coming up on the 31st of July about whether President Trump legally overreached himself with the tariff and the executive order. So that's perhaps another thing for markets to worry about. And we have the big, beautiful bill rumbling around in the background where you still have a lot of investors on this side of the Atlantic fixated on the American sovereign debt and how that's continuing to gallop higher even before the bill, let alone after it. So there are still plenty of things for bears to get their teeth into, but at the moment, they're not getting any joy out of the share prices.
For sure. Jay, Russ, thank you so much. Jay, I know you'll be staying with us for the rest of the show here. We appreciate the conversation kicking off the 10 a.m. hour. We've got much more market catalysts ahead. Stay tuned. You're watching Catalysts on Yahoo Finance. Time now for some of today's trending tickers. We are watching Novo Nordisk, Hims & Hers, health insurers, and Bank of New York Mellon. First up, Hims & Hers shares plunging after Novo Nordisk says it's ending its partnership with the company that allowed the direct sale of its Wegovy. The pharmaceutical company saying Hims & Hers allegedly failed to follow laws prohibiting mass sales of compounded drugs and accusing the company of deceptive marketing that put patient safety at risk. There you're taking a look at the share price reaction here for both of the companies here. And it's notable because as what we had seen with Hims & Hers, it was certainly an effort by them to ensure that they could have some type of weigh in on the user demand that they've seen flow into their different products, where they had largely looked across some of the patents that had expired and knew that they had to be in on the weight loss drug trend as well. And so partnership with Novo Nordisk was significant, but now it also means that you have to comply with some of the service level agreements or expectations that that company you're partnering with has too.
Yeah, it's been a tough ride for Hims & Hers shareholders. I mean, the volatility in that stock has been epic, and it goes from one drug to the next, whether it's ED medication or now weight loss drugs. They have, so much promise, such a great and loyal user base. It's a fantastic alternative for people. It's secretive, it's online, it's right to your door. So when this news happened, maybe it was a little bit of an overreaction, but to see it fall over 20% last I checked, extreme. And so we have to see what the next step is for them, but this was a big blow to their shareholders, and we'll see how they recover from that.
Yeah, shareholders who've watched the stock actually move higher, even with today's move, it seems, move higher year to date, 82%, but this major pullback certainly is going to test some of the mindset around the investment thesis for Hims & Hers. Yeah. We're going to be continuing to watch that. We're also watching major health insurers signal a move towards simplifying prior authorization requirements for medicines and services. So America's Health Insurance Plans, an industry organization for insurers, they say that insurance companies will develop standard data and submission requirements by January 1st, 2027. Additionally, major insurers will cut down on claims that require prior authorization by January 1st, 2026, and will make sure authorizations are valid for 90 days if a patient chooses to change insurers during the treatment here. You're seeing shares kind of move in different directions for United Health, which has been facing its own problems over the course of the year. But then two of the other insurers that we were showing on screen still moving higher here. And the insurance space is undergoing a vast majority of targeted changes, whether that be in how the claims are adjusted and looked through and evaluated, all the way through to the pricing and how the different models in their pricing are carried out as well here. So a spate of changes that could be coming over the course of this year, which has given investors a lot to think about with these insurance.
Yeah, it's been the one sector in troubled times that usually does well, and it's been the second worst performing sector year to date. Only discretionary lags, and it's one of two that are down. We know UNH has had their own troubles. That goes without saying, but the sector itself has been beaten down. Anything that can, one, help us as users of these platforms streamline operations, cut costs down.
Oh, we'd love that.
Yeah, I mean, it's ridiculous, but this is something the Trump administration had talked about for a while. We just have yet to see some results, and this may not bode well for the insurers themselves, but for the utilizers of those insurances, anything to streamline operations would be great. So I don't see an uptick in the sector as a result of something like this, but it's positive progress, at least for you and I.
Absolutely. And finally here, in our trending tickers, we're continuing to track Bank of New York Mellon eyeing a potential merger with Northern Trust. This is according to the Wall Street Journal here. Now, the chief executives of Bank of New York Mellon and Northern Trust reportedly had at least one conversation, and BNY is considering next steps. BNY had no comment on the report here. A merger between the two companies would create an investment management giant overseeing more than $3 trillion in assets. There you're taking a look at both of these firms. And the larger question upon the industry and the sector at large for banking and financial services is what this means for broader consolidation efforts right now to shore up some of their own operations.
We have been waiting for a story like this to happen for ages. I'm talking 15, 20 years, pre-financial crisis. We've had bank mergers, but what have they been a result of? They've been a result of failures, results of insolvency from some of these smaller banks. We had the regional banking crisis. So for this to start, this is something that we had predicted would happen under the Trump administration. Lack of red tape, a lot of regional bank M&A activity. I look at some of these bigger regional banks, the PNCs, the M&Ts, the Regions Financials of the world, technically they've broken down trends and they're looking like they want to reverse. You look at this Northern Trust, okay, it's trading around 120, 122. I didn't see the last sale, but its high was January 13, 2022 of 133, 135 in that range. So if this deal is going to get done and there's a little smoke, usually these things do get ironed out. I think there's an upside to at least that level to get the deal across the finish line, and the stock had been doing well. So this, to me, is fantastic. And when you have Bank of New York Mellon, first stock to ever trade at the New York Stock Exchange, fun fact, BNY, Alexander Hamilton. He's not involved in this deal, but this is something that investors should be happy about. If you look at the KRE, which is the regional bank sector, a very wide swath of them, underperforming the BKX, which is, includes some regional, some of the larger banks. This is something that you may want to take a flyer on because this goes through, this happens. There are going to be a lot of other people having conversations over the few upcoming months.
It's interesting, and it brings me back to one of the thought processes that we had heard from Torsten Slok of Apollo, the chief economist there, who had put out within his banking sector outlook. Banking sector balance sheets are generally in good shape, credit growth positive, driven by lending in large banks, but it does make you consider how many of these banks are trying to make sure that they're diversifying their streams of revenue and their income here, and what could be possibly pushing this deal forward is that thought process from these two major entities.
Oh, without a doubt, and this would put Bank of New York into the Chicago market.
Exactly.
They have Pittsburgh with Mellon, but to me, yes, rates have been stable and steady, higher for longer. They've absorbed this, all the banks have. Mortgage market has been kind of tricky, so maybe it's a time for some of these smaller banks to find a larger partner, and you get some of these super regionals joining forces. To me, it makes sense, and we have the administration to back it. So I think this is something to really keep a close eye on going forward.
Yeah, to your point, potentially larger footprint that we could be seeing here if this goes through. You could scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Federal Reserve Governor Michelle Bowman signaling she could support a rate cut in July. Yahoo Finance's Jennifer Schaumberger joins me now with more on her comments. Jennifer, what do we know?
Yeah, Brad, a sharp turn there from Fed Governor Bowman to become dovish. Bowman saying in a speech this morning in Prague that she could support a rate cut as soon as the next policy meeting in July if inflation continues to remain mild, and as she now sees greater risks to the employment side of the Fed's mandate rather than inflation. Bowman saying in that speech, quote, "As we think about the path forward, it is time to consider adjusting the policy rate." She went on to say, should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting in order to bring it closer to its neutral setting and to sustain a healthy labor market. Bowman says that as inflation has dropped or come in below expectations the past few months, that the Fed should recognize inflation appears to be on a sustained path towards its 2% goal, and that there will likely be only minimal impacts on inflation from changes to trade policy. She said it looks like any increase in goods prices from higher tariffs is being offset by other factors, and that the underlying trend in inflation is moving much closer to the Fed's 2% target than is currently apparent in the data. She pointed to lower housing inflation that looks to be on a downward trend and noted that only inflation on core goods remains somewhat elevated, likely reflecting limited pass-throughs from tariffs. Bowman also said she expects that trade negotiations will actually result in lower tariff rates than are currently in place, and that if we do see effects on inflation this year, that she expects increased slack in the economy will be limited to a small one-time impact. Bowman, the second member of the Federal Reserve, in addition to Fed Governor Chris Waller, to say that she supports a rate cut as soon as the July meeting. And this is in direct contrast from what we heard from Fed Chair Jay Powell last week during the press conference, when he said he's content to hold rates steady for now, as he thinks we haven't seen the impact yet from tariffs on prices, and that he wants to wait and see how that evolves over the coming summer months, that perhaps there is inflation still yet to come. And we certainly saw that borne out right in that dot plot, where there were 7 members of the Fed who don't see any rate cuts this year, and 8 members of the Fed who still see 2 rate cuts this year. And we will hear again from Fed Chair Jay Powell when he kicks off 2 days of testimony before Congress, starting tomorrow, Tuesday, before the House, followed by the Senate on Wednesday, where I would fully expect him to reiterate that the Fed is content to hold rates steady until they see more impact from tariffs on inflation. Back to you.
Jennifer, thank you. Appreciate it. Well, Jay, let's continue that conversation, because one of the things that may have jumped out to a lot of people when they heard Fed Chair Powell's press conference last week was that the median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, same as projected in March here. What would need to happen to get us down to that roughly 4% rate here, especially considering right now we're sitting at the current rate of 4.25% to 4.5%?
Yeah, well, what would need to happen? 2 things. Well, there'd be 2 cuts. So, if we kick the can past July, we have September, we have 2 meetings after that. So he would have to set the stage for that. Right now, he was a 1 data point at a time guy. Remember that? And the data, while we have fears and concerns of inflation, and he mentioned it could be transitory, but then we got Liberation Day, which threw a monkey wrench into everything.
Transitory is a cuss word at this point, essentially.
It is, but he used it. I'm just repeating what he said. Don't pick me. But no, he was 1 data point at a time, and now he's concerned about global events and the possible spike in crude. Well, the market is showing us it's not concerned. So he is losing that concern ammunition to cut rates. We are at the same place we were inflationary-wise. In fact, the CPI has ticked down every month this year. So if we were going to do 2 cuts, the plane is set to take off in the direction of those cuts. Let's get moving. And now we didn't have any dissent from the Fed chairs, from the Fed voters this past meeting. That's interesting. But then Waller goes on TV. Bauman now coming out saying very dovish things, proper things. Yeah, we could cut. Are they being political and jockeying for Powell's job in 9 months? That is another question. So you want to try to throw the political side of things out of it.
Sure.
But why didn't they dissent when they had a chance to dissent at the meeting? Bauman's dissented before. So I want to hear them get more vocal. This is where they're speaking. This week, the Fed speak. I was just looking it up. They're everywhere, making the rounds. So we're going to get a lot of this rhetoric. Let's see if there are any hawks, but right now we're getting a lot of dovish commentary. The global concerns seem to be muted for now. So I think even though the odds are for a 10% chance of a cut in July, that rhetoric will heat up, and then September we should be set for it if nothing crazy happens on the geopolitical side of things.
Well, that's the big question that I was going to ask you. What happens if the Fed has to navigate through even longer periods of uncertainty? And I mean, if the can gets kicked down the road on some of the tariff negotiations, which they talked about. And of course, they have to answer questions around swings in net exports driven by businesses bringing in imports ahead of potential tariffs. You got to think that businesses are still trying to position themselves to outlast both situations, an easing in some of the tariff pressure, but also a longer run tariff rate that they would have to incur.
Yeah, I mean, we have kicked the can down the road. They got in front of this, and now we're going to see, imports decreasing. So what does that mean? Did they position themselves? Now that we will get some deals, and those deals, as we talked about in the last segment, may get kicked down the road even further, a little of the taco trade, if you will, negotiate in good faith. That will at least keep the numbers and the data soft, where if we're data dependent, let's take that cut. You know what needs it? The housing market. Bowman talked about it being stable. Well, it's stable at elevated levels. Sellers are now outweighing buyers. We're going to get some housing data this week, so it's going to be interesting to see. We get the PCE later on Friday. So the data is there, and the data is telling us, based on what you told us setting this up going into the year, we can cut. And 2 cuts, it still looks like it's going to be in the cards. The question is when, and does something get him nervous where they say, no, now is not the time. We're going to do it at the next meeting. We're running out of time. So July, I say no. Jackson Hole, very interesting. Jackson Hole always moves the market. That's in August when they all get together and they camp out and they talk about their decision. And then September will be the one where we'll get some fireworks for sure. Absolutely.
We're going to get a lot of housing data over the course of this week, and we get even more of the read-in on the consumer over the course of this week through some econ data. We've got all your markets action ahead. Stay tuned. You're watching Catalysts. One hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, we've got senior reporter Ali Canal. Hey, Ali.
Hi, Brad. Well, we are firmly in the green here. Now, we did see some positive manufacturing PMI data earlier this morning that could be helping to lift sentiment. But if we take a look at the Wi-Fi Interactive, you're going to see gains across the board, green across your screen here. NASDAQ Composite up about 0.5%. Same with the benchmark S&P 500. And then the Dow Jones Industrial Average up around 150 points here. Now, oil, that's been the main focus here. And to that point, we're actually seeing crude oil slide. We are now hovering around $73 a barrel. Brent, the international benchmark, is down below $77 a barrel. And this comes as President Trump has issued a warning to investors, to traders. He published on Truth Social, everyone, keep oil prices down. I'm watching. You're playing right into the hands of the enemy. Don't do it. So it seems like for now, the president has gotten his wish. I also want to look at Bitcoin prices. Now, Bitcoin is often a sign of investor risk appetite. To that point, we are trading to the upside right now, up around 2%, just below $102,000 a coin there. We are seeing a slight edge higher of the US dollar, although we were still below that critical psychological and technical 100 level, as there's been a larger discussion about US exceptionalism and whether or not that is waning. And then no surprise here to see yields tick to the downside here. We have the 10-year yield at around 4.3% and the 30-year yields just hovering at 4.85% here. So, all in all, this is really saying that markets have dismissed at this point the risk of a prolonged conflict. Nick Kolas, he's a co-founder of DataTrek Research. He said in a note earlier today that markets are likely going to continue to discount downside scenarios here and could even resume their rally, even if we continue to see negative headlines. So there's a true disconnect between human nature to just look at what's going on currently and then the market's desire to look ahead into the future. So we could potentially continue to see some volatility on that front. But for now, we are trading in positive territory.
And Ali, what do we know about how markets usually react or historically have reacted? Of course, past performance not indicative of future results. But when we do have geopolitical tensions, what has typically been how this plays out within equity markets?
Markets typically look through it, and I want to pull up a chart from Morgan Stanley analyst Mike Wilson, and he basically analyzed key geopolitical risk events since 1950, and following these events, the S&P 500 has typically bounced back, rising an average of 2% 1 month later, 3% after 3 months, and 9% over the next year. Now, the real bear case here would be if we did see a major spike in oil prices, but analysts there say that we would need to see crude prices jumped more than 75% year over year. That's over $120 a barrel. We're actually down about 10% year over year currently. So this would take a sustained disruption in the Strait of Hormuz, which is that critical choke point for global oil. That would be needed in order to push prices higher. And so far, we have not seen that from Iran, although they have threatened that they would close the Strait of Hormuz. But that is something that investors will continue to track and watch closely. But again, oil prices moving to the downside currently.
Ali, thanks so much. We'll be checking back in later on. Still with me, we've got Jay Woods, Freedom Capital Markets Chief Global Strategist here. You know, as I'm thinking about some of the animal spirits that we expect to play out in a time like this, where do we see that jostling between the bulls and the bears? And is it, in what we're seeing today, typical of what we've seen in the past as we were just breaking down?
No, we were breaking down what to expect on a rally after a global event. Well, we didn't even get the sell-off to rally back from. So Mike Wilson's stats that we just looked at are great if we had a sell-off. We haven't even had that. So as a bull, I'm kind of shaking my head. I wanted a little dip to give us an opportunity to buy some of these stocks. And then when I look at the 11 primary sectors, one is down. Which one is it? It's energy. So this is, you know, we've seen a lot of different markets over years. I mean, you're not as old as I am. I've been doing this for a while.
We've both been down on the exchange.
You think logic would prevail, and the market tells a different story, and the market always tends to tell a different story. So to me, the market is telling us that, you know, things are not as bad as they seem right now. And to me, you know, this could set up for a chase later on in the second half of the year as we have digested tariffs. Yeah. We saw the worst hit we could take from that. Now we know what the worst case scenario is. Right. And we don't know with this conflict. And I believe we get to interview a general later on in the show. Yes. So I'm curious to hear what his concerns would be, because if we think this was just so easily done, we bomb the nuclear sites and then there's nothing to fear going forward. I hope that's the case. I really do. But you're always trying to play defense and look for different setups. And there are energy setups to me that could still break out that look like you may want to put some of your assets in there just in case this conflagration becomes, you know, an inferno. Right now, it was just a small fire and we looked like we extinguished it.
Well, and as mentioned by one of the market guests that was on in opening bid, I believe, talking specifically about, and actually it was Ian Brimmer who was joining during opening bid, saying that the other major consideration is what if Israel takes further attacks or continues to roll out its own pressure on Iran? What does that look like in terms of bringing other allies or other countries into the fray there? And that's a major spillover.
Oh, I agree. And let's not forget about China. I mean, China was asked to come in and negotiate, you know, possible closure of the Strait of Hormuz. China's in negotiations with us. So let's see if that kind of comes into play. But right now, all our allies are kind of taking a step back, and Iran does not have anyone really jump into their corner to say, "Hey, this was a mistake." I know Putin said it was, it was illegal, but who is he to talk when it comes to doing things illegally in the war games that he's playing with Ukraine? So we'll see where it goes.
Absolutely. We've got much more on this discussion here. Switching gears, though, and we got to bring some news to your attention. FedEx founder Fred Smith passed away on Sunday at the age of 80 years old. Smith started the company in 1973, delivering small parcels and documents at a faster rate than the U.S. Postal Service, growing it into the shipping giant it is today, delivering an average of 17 million packages per day. Smith stepped down as FedEx CEO in 2022, passing the mantle on Raj Subramaniam. Yahoo Finance had the chance to speak with Subramanian about working with Smith, and here's what he had to say.
Taking over from a founder like Fred is a whole another level of stuff, because because the trust that he placed in me in giving what he's built over the last 50 years in my hands. He's ultimately a patriot for this country and how to shape government policies and so on and so forth. So we have a unique and great partnership, and I wouldn't trade that in for anything else.
FedEx releasing this statement this morning on Smith's death. Pioneer of an industry, founder of FedEx, mentor to many, a source of inspiration to all. Bravo, Zulu. It's time now for today's chart of the day. A number of companies reporting earnings this week, including FedEx, Carnival, Micron, General Mills, and Walgreens. we're watching how traders are positioning ahead of earnings here. And just to set the stage for it, FactSet for Q2, they're estimating that year-over-year earnings growth and the growth rate specifically for the S&P 500 should come in at 4.9%. Now that would mark the lowest earnings growth rate since Q4 of 2023. And so here's how investors are thinking about some of the potential moves that we could see, implied versus the actual moves. And this is where, for some of the companies that we're going to be tracking over the course of this week, where the implied move, as you can see, denoted in green here, and the average move after previous results. And so that implied move is the expectation. And we can do this by looking through a range of factors here. You can look at things like options contracts, where if you're looking at some options AI data, as I did before we were taking a look at this chart, options AI is actually pricing in the potential for a 9% move based on some of those options contracts data that's ingested to really understand how investors are positioning themselves going into the earnings reports. Now, what's also interesting, and FactSet had mentioned this within their most recent note, encapsulating the earnings tenor that we've heard over the course of this season and preview into next season as well, you could see inflation and tariffs be two of the most mentioned, or the mode in terms of some of those conference call mentions that we hear from executives. So that's what to watch. And over the course of this week, we'll hear directly from some of these names that you might be talking about within your household, at your trading post, or even just as you're boarding a Carnival cruise line as well. So all of that considered, those are some of the ways that investors are going to be watching. And you can see for some of these names where there is a significant pullback versus the previous results. Look no further than Walgreens Boots here, and certainly one of the pharmacy benefits managers that's seeing a changing landscape for its business. We'll see exactly what that looks like for Walgreens, that has both retail and pharmacy encapsulated all in one, and could see a much shorter or much smaller move than versus what we've seen in the past on earnings results as well. I want to switch gears here, bring in Jay Woods, Freedom Capital Markets Chief Global Strategist, back with me. And Jay, ultimately, as we think about some of those earnings that are coming out this week here, what are your anticipations for how investors should be reading through some of the commentary from executives, even at this juncture, knowing that they're evaluating a far different range of scenarios than the CEOs that were announcing at the beginning and the front end of the earnings season?
It's a fascinating week. Yeah, I'll touch on the top two stocks that you mentioned, the Microns and the FedExes of the world. But what investors want to know is that guide. I mean, whether or not they beat or not is obviously important. We want to see them beat, coming in line with strong guidance going forward. Micron is very interesting. You get a nosebleed if you look at that chart. The RSI is almost 85. You don't see stocks get that overbought. It's 100% off its low after Liberation Day. And it reminds me of two other stocks that did well over earnings season, CrowdStrike and Broadcom. Both broke out. Both were looking good technically, but got a little too far out over their skis, had great quarters, and what did they do? They pulled back. So for Micron to continue on this road higher to all-time highs, it's going to take an epic beat and guide. So I look at that as maybe the news is baked in. It could pull back 114, 115, a good entry point. If it's really bad, then it goes back into a neutral trend, and we're talking 200-day moving average. But FedEx is the interesting one. FedEx has been beaten down for months. Tariff concerns have really been a focal point for them. Their guides have been weak, and then you look at it technically, it's coiling. It's right in this apex between a near-term uptrend and a longer-term downtrend. This 230 area is something investors need to watch. If it can break above 230, you've got clear sailing to about 255, a nice 10% return back to its 200-day moving average. Then we can reevaluate the trade. But FedEx is one that has really been a focal point when it comes to tariffs. Let's see what they say going forward, see if anything has changed on the horizon there. Maybe they even talk about AI, because we know Amazon mentioned robots and AI. So we'll see if there are cost-cutting measures in place. So those are the two that I watch. And then one you didn't mention there is Nike.
I was just about to bring that up with you, though, because the swoosh, of course, is done by so many athletes, whether that is athletes that are played, on the field or the court that we were watching last night in the NBA Finals. And then, of course, by our beloved Philadelphia Eagles as well.
Go Birds.
And a few key players there. So what are we watching for there?
Yeah, we're watching for that turnaround. They had new management. Elliott Hill's been at the helm since the beginning of the year, and the stock, one, was the culprit, or the victim, not the culprit, but the victim of that tariff, the big chart in Vietnam. Whoa, we didn't see that one coming. It sold off. It got as low as 52. Right now, it's holding a key support level 59. It's 50-day moving average, but long term, it's in a downtrend. And this is a story that's going to take a lot of time to turn around. But if we get a little bit of a rally, the upside to me is to 70, but it's in this show me state where I would rather buy it on a dip and hope you get a double bottom around 52 than chase it, because every time you try to chase this stock, it's been faded. So I think the turnaround there hopefully starts this quarter with some upbeat forecasts, some Caitlin Clark sneaker that everyone's waiting to see.
She's wearing Kobe's right now.
I know, but we need Caitlin's. We don't need Kobe. She can wear her own shoe. And you see the ratings. She was out for 5 games. The ratings of the WNBA shrunk 50%. They're on the road. Everyone's there to see Caitlin. So you got a catalyst there. They need to embrace her because that market is tremendous. So I want to see something big out of them. Technically, we do have potential for an upside here of about 15 to 20%. I love it. But long term, there's a lot more to show. So I think that we're going to get a nice tradable bounce out of this. If it fails, I still want to buy it. If it rallies, I chase it to the 200-day moving average. But long term, is the turnaround coming? Let's see what they come out with. So it'll be a fun one to watch this week.
Yeah, that one drops June 26th in the afternoon after the close of trade here. Jay, thanks so much.
You got it.
Coming up, why Eli Lilly is ending a deal with Hims and Hers. We'll discuss that and break it down for you investors out there. Shares of Hims and Hers falling today as Novo Nordisk ends its deal with the telehealth company over concerns that it continues to sell the cheaper off-brand weight loss drugs. Yahoo Finance senior health reporter Anjali Kamlani has the latest on this one. And you helped me break this one down before. This comes back to the compounds of it all as well here. What more do we know about this decision?
Yeah, so this is a surprising move from Novo because they did already know that Hims was selling the compounded version of its drug, but I think there was some sort of expectation that they were going to either, completely take it off market or slowly take it off market, and they haven't done so. They are continuing to sell semaglutide, which is the chemical compound and active ingredient in Novo Nordisk's Wegovy and Ozempic. Wegovy being that weight loss drug that Hims had access to directly sell to consumers. That was the agreement a month ago. Now, this has recently come into focus. We know that Eli Lilly has been pushing back hard on these telehealth companies as well as Medispas. Both Novo and Lilly have been going after anybody that is selling through lawsuits these compounded versions of the drugs, and some compounding pharmacies continue to sell them despite them not being allowed to anymore. They were initially allowed because of the shortage of access to these drugs. Both Lilly and Novo struggled to fill the market, and so the FDA allowed these compounds on, recently taking off, and these compounding pharmacies believe that they have a reason to be able to by calling it personalized. And so there's sort of a loophole, if you will, in the FDA rules that allows them to sell personalized drugs, and that's exactly what Novo called out in its comments, saying Hims and Hers has failed to adhere to the law which prohibits mass sales of compounded drugs under the false guise of quote-unquote personalization. And that's why Novo is no longer working with Hims to give access.
Jay, we were talking earlier about the significance of this deal for Hims and Hers as well as for Novo and trying to get into an audience base that Hims and Hers has done a very good job at building up over the course of years now. And so now, as you think about the pathway forward for Hims and Hers, how much more difficult does that become, especially with the allegations put forward by Novo?
Well, it's definitely a challenge, and we're seeing it in stock price. Eli Lilly is up. Novo is down on this news as well. To me, that is the big question. What has Hims come back and said? I'll ask you, have they come out with a statement to refute this? I've been with Brad, so I haven't been able to pay attention what happened over the last hour.
Yeah, no. We have been in touch with Hims, and I know we're going to be receiving a statement. We haven't got one yet, but it is interesting that they do continue to choose to sell the compounded version because we know that there's so much pressure on them for this reason, as well as the fact that they already have that agreement with the branded drug company. So it's interesting that they've chosen to continue that tells us pretty much what we already know, which is the compounded versions are so much cheaper that it creates so much more access.
And so what do we know now about the pill format and some of the advances that companies, biopharmaceutical companies, are looking to push forward there?
Yeah, what a week for a lot of this news. The American Diabetes Association is meeting this week, and so that's where all of this GLP-1 news is going to be coming out. We have some for you later today as well. But the news this morning we have is that Lilly's orforglipron, that is the GLP-1 pill, which is potentially the first to market if Novo doesn't beat them to it, has no surprises. They have still maintained all the data that they have previously exposed, which is, good safety tolerability and good weight loss. That weight loss is a little bit lower, I would point out, than what we are used to with those, 20% numbers with the injectables, but it is still promising. They've tested 3 different doses and all looks good there. No surprises from investors. Meanwhile, Wegovy came out with its higher dose. Novo Nordisk came out with a higher dose of Wegovy, 21% weight loss there. And looking at its next-gen GLP-1, CagriSema, that's been kind of disappointing to investors, but there's still some looking at potential good news there.
Absolutely. Ansh, thanks so much. And thanks for getting the pronunciation of orforglipron correct as well.
I've been practicing.
Guys, coming up, we've got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. "90 minutes into the start of U.S. trading. I'm Brad Smith. Let's get a check of the markets here. Taking a look at the major averages right now, we are checking in on the Dow. There we go, the S&P 500 and the NASDAQ. We are fractionally higher across the board as of right now for the Dow, seeing gains of about 0.1%. The S&P 500 up 0.4%, and the NASDAQ is also up by about 0.4%. In the bond market, flipping over to the 5, the 10, and the 30-year yield, you're seeing some declines here that are accelerating actually across the yields, as we're seeing a decline of about 1.5%, about 6 basis points here for the 5-year yield, and then additionally here some steep declines here, at least as of right now, and then fractional decline on a percentage basis for the 30-year yield. We'll continue to keep that close in mind here and on the eye as we move on throughout the rest of today's session here. Coming up this hour on Market Catalysts, we break down today's trading action with geopolitics front and center for investors. Plus, are interest rate cuts on the table? We'll discuss and get a preview of what to expect from Fed Chair Powell on Capitol Hill this week. And for today's Investor Playbook, we'll look at the winners and losers of the AI trade, all that and much more coming up on Market Catalysts. Well, investors are monitoring the escalating situation in the Middle East after the U.S. struck 3 nuclear sites in Iran over the weekend. Iran has vowed to respond, saying it, quote, reserves all options, while President Trump warns that retaliation will be met with even greater force. One possible consequence could be Iran closing the Strait of Hormuz, which transports a quarter of the world's oil. Shipping officials telling the Wall Street Journal that half a dozen ships have diverted course on the way to the strait since Sunday. Here to respond is General Wesley Clark, Chairman and CEO of Wesley K. Clark and Associates. General Clark, good to have you here this morning. You're also a former Supreme Allied Commander of Europe of NATO, Commander Europe of NATO, and still with us, we've also got Jay Woods, Chief Global Strategist at Freedom Capital Markets here. First and foremost here, General Clark, I want to begin with you here. What is the natural conversation that takes place, especially within the rooms that you would be sitting in after a strike like what played out over the weekend?
Well, I think we're looking at bomb damage assessment to see what's really happening. We're trying to get the intelligence of what's going on the ground. I think we're getting information privately from the Israelis about what their target priorities are. Those target priorities seem to have shifted from mostly nuclear and missile to now they're going after some regime change targets like the prison and Basij headquarters. That's going to continue. There is discussion in Iran, apparently, and always is, about who's in charge and what would happen and will there be a regime change. But right now, the instruments of repression are fully out in Iran. And so there are forces in Iran, groups that would like to challenge the regime. I think they're still cautious about doing it. It's going to take several more days of Israeli effort. Meanwhile, the great powers are now starting to form up. Russia has said, Putin has said he'll support Iran. China's worried about the Straits of Hormuz closing, but they would probably blame us for that rather than the Iranians. So we're just at the beginning, really, stage of this.
Okay.
It's not over by a long shot.
All right. So Jay, if this is not over by a long shot, how should investors be thinking about the risk of prolonged risk to the market here now?
Yeah, well, right now investors are shrugging this off, and they're hopeful that this is more of a tactical strike and Iran does not strike back. And I'd like to ask the general, first of all, thank you. It's an honor to be with you. As you know, someone that has PTSD from 9/11 still, are you concerned about a lone wolf or possible strike back on the American people or American targets overseas? What are your biggest concerns? Because it seems just too easy that this is one and done.
Well, of course, Iran is going to have to, if they've got a structure of their government, they're going to have to strike back. But what are they going to do? If they come after us in the United States with terrorist attacks, boy, that's going to really bring down the world on their shoulders. So they may threaten it. That's one of their last resorts. Easiest thing to do, have the militias harass U.S. bases in the area, maybe lob a few drones or rockets at some U.S. bases, and continue to threaten to close the Strait of Hormuz, but not to do it. They've got their own problems right now because the attacks that are coming in on Israel are affecting their ability to organize, command, control, plan operations. So they've got they're under the weather right now. They're always cautious about responding. They should be especially cautious now because the hammer is there. There's plenty of military power to strike them. The real issue here for the markets is what comes next? What's the objective, really? If we get regime change, what does that mean? We're going to have 92 million people in chaos. We're going to have continuing factions fighting for control. What about those 3 million barrels a day of oil from Iran? Is that going to be interrupted, destroyed? What does it mean for the neighbors in the region? There's lots of anxiety in the region. Our markets may be shutting it off, but I can promise you people in the region are fully aware of the downside potential here.
Some headlines coming out from Iran saying that our response to U.S. attacks will be proportionate. So how do you evaluate what a proportionate or assess what a proportionate attack could look like, especially knowing the reaction that we've seen from other world leaders and officials in reaction to the weekend's events?
A proportionate attack hit some bases in the region. Strike them hard with multiple rockets, but don't strike everything. That would be a proportionate attack, and maybe combine it with a ground assault from militia.
And so with that in mind, I do want to round up for you some of the responses that we've seen from other diplomats, some other world leaders around the world, the UK and the EU calling for de-escalation and a return to the negotiating table. You've got Russia and China also condemning the US for its attack. All that at the same time where there are larger tariff risks that they've all trying to negotiate, at least in some form or another, in good faith here. And so how much do the countries that are at the negotiating table need to detach themselves from tariffs at this juncture just to deal with an escalation that has played out over the weekend?
Yeah, I think the countries are concerned. I mean, it's the normal thing you'd say and hear from Europe, let's de-escalate. But the truth is that Israel wants to escalate. Israel wants to achieve escalation dominance. That's the best way, they believe, to either break the Iranian regime or bring them into some favorable negotiations. At some point, we may need international mediation, not from the UN, but the way we did it in Kosovo in 1999 was with leaders of other countries who could go in and talk to Milosevic. Maybe someone's going to have to go in and talk to the Iranian government at some point and say, look, bud, you're out of options here. You got to stop it now or you're going to lose greater. We're probably not at that stage yet.
General, another concern is a potential cyber attack by the Iranians. Do you think that they have the capabilities to do something that could be damaging to some of our infrastructure? Or do you think that the American infrastructure is basically ready to take on anything they throw our way?
I think we can handle the Iranians. I'm a little bit worried about the banking and distributed denial of service attacks. I know we've had this in the past, but in terms of the broader infrastructure, I think we're relatively in good shape as long as the Chinese and Russians don't join in. If they join in, then we're into a much different situation. I'm sure that Israel right now is doing everything it can to block any cyber activity on the part of Iran. I can't speak for the United States. If I knew, I wouldn't be able to say it, and we'll never learn it.
You know, with that in mind, you mentioned China, and it seems based on a ministry statement that they're saying, their foreign minister is saying in China, Israel attacks on Iran on the basis of possible future threats sent the wrong signals to the world. And it seems like that is what's being echoed in some of the statements that we're seeing from world officials here. And so how do we best ensure that there is not an escalation? Because now you have the U.S. administration calling for de-escalation and trying to get to a nuclear deal while also saying, well, we just blew up the nuclear site, so we've mitigated the threat, and now you can come negotiate with us. But what is the reality of how negotiation could even move forward from here?
Well, the reality is that as long as the Iranians think they can fight back and they've got strong allies, you're only going to get a sham negotiation. You're not going to get a real negotiation. And so Israel is going to have to put the pressure on, continue the pressure militarily against regime targets, the targets that support repression inside Iran. And that's the way the Iranian government will finally recognize they're in a very weak position. It's time to talk Turkey.
General Clark, thank you so much for taking the time here with us this morning. We've got much more to discuss on the matter, and we certainly do appreciate you hopping on Yahoo Finance.
Thank you.
Jay, you're going to stick around with me. We've got much more to talk about straight ahead on Catalysts. You're watching Yahoo Finance. Let's get a check on defense stocks with Yahoo Finance's Julie Hyman live from the New York Stock Exchange. Hey, Julie.
Hi, Brad. Well, as you would imagine, there is some increased attention on defense stocks given the U.S. Strikes in Iran and even also the ongoing conflict between Iran and Israel. We are seeing some action in defense stocks, but we are not seeing a big across-the-board increase in many of these shares. A couple of things to mention with that. First of all is that the stocks have done very well already. The iShares ETF, the Aerospace and Defense ETF, ITA, that tracks these stocks, is up around 25% year to date. So we've already seen them outperforming on the conflicts that have already been happening, and the idea that even with some of the federal government cuts, there is still money that is earmarked for defense spending. That said, there was an interesting note from Jefferies this morning, which sort of dug into the exposure on the part of specific defense companies. There's a company called Elbit Systems, for example, not as much of a household name as the large guys like a Lockheed Martin or Northrop Grumman, but according to Jefferies, 29% of that company's sales are to Israel, 27% to Europe, 22% to North America. So we could see that present more of an opportunity for that company. 19% of Lockheed Martin's sales from missiles and munitions specifically, and 13% exposure to these kinds of conflicts from LHX, L3 Harris. So that's sort of the breakdown specifically for some of these companies. Northrop Grumman's B-2, which played a role in these attacks, represent about 2% of its revenue. But again, when you look at how these defense funds are allocated, at least here in the United States, they're allocated well in advance. They're not necessarily allocated specifically to conflicts as they arise. It's more to have them in reserve to be prepared for situations like this. Also want to mention Boeing, which some of the aircraft used in these attacks represent part of their defense business as well. Besides this particular conflict, another catalyst to keep an eye out for is the increased potential NATO defense spending that we could potentially see in the coming days. So that's something also to watch and to keep an eye out for when it comes to these defense stocks. But again, they've already done very well. So some analysts are saying some of this could already be priced in, as well as future defense spending too, Brad.
Thank you so much, Julie. Boxing out traders down there getting the reporting from the New York Stock Exchange. Appreciate it. Checking back in on Tesla, the company launching its highly anticipated robotaxi event in Austin over the weekend. Yahoo Finance senior autos reporter Pras Subramanian joins us now on this. And of course, guest contributor Jay Woods still with us. So Pras, did the event live up to the hype going into it?
I mean, I'm looking at this stock move right now, up over 10%. I was shocked because pre-market it was up 1%, a little bit like that. All of a sudden, huge gains today. I mean, look, it was a small test. 10 to 20 vehicles operating down in Austin. You've seen a lot of videos of people, Tesla fans, people like that who were able to get in on the test, tweeting about it, showing one guy did 11 trips, he said yesterday, right? No issues so far. But look, it's a geofence test as safety operators, including a teleoperator too. So not exactly a full robotaxi sort of experience, but apparently a successful launch yesterday. I got to ask about, scale. How do you scale this business? That's a question that Dan Levy had, like a great test today, but what happens down the line? So I think there's some issues there, but for Tesla bulls and the stock right now, I'm surprised at the 10% move.
Yeah, and so Jay, as we think about that 10% move and how investors are reacting here, we know that for the animal spirits, there's typically a ton of bullishness within the Tesla name. However, we have seen some of the bears have their way with the stock over the year too, given Elon Musk's annexation to the White House, but now reinserting himself in a lot of the day-to-day operations at Tesla.
Yeah, I'm surprised at this move too, up 10% and climbing. I look at it technically, if this breaks 365, you've got some smooth sailing ahead. Some of the things we haven't talked about is the de-escalation of the war of words between the president and Elon Musk himself. And then, as you mentioned astutely, it was a limited number of rides in a strict area, and it was influencers in the back of the car. What are they going to say? They're I don't know if they're paid influencers to go into these cars, but it was very optimistic. But I still sit back and think, Waymo is in 8 cities and they don't have geofencing. They're going slowly, smoothly along. They just lack the magnanimous leader that is Musk. So I think Musk himself showing that this is a success, a big step forward, much needed, and then de-escalating the war of words with Trump is really what's got investors excited. But to me, every time I talk negatively about the stock, I don't know, we should talk about this off air. The internet blows up, you're evil, and it trades like a Colt stock. And right now, the Colt is very happy.
Yeah, I think that you hit the nail on the head right there with the Musk is back on his main quest, they say, right? Mm-hmm. He's no longer part of the government. He's strictly supposedly devoted to Tesla and all his other companies. And that's probably a big part of the enthusiasm. They said they're going to launch it on the 22nd. They actually did it. It's happening. But like you said, what about the general public? When are we going to be allowed to do that? That's a big question, I think.
Yeah. Another big question here, too, as we're in the auto space that we're considering here. Today's the first day for Stellantis' new CEO. So what's the road look like ahead there at the brand and at the company?
So he made a couple moves here in the executive ranks, nothing too crazy. One smaller executive was pushed out. Veloso is going to actually remain North American head as well as a global CEO. He is a known quantity there. They like him. He's Italian. Most of Stellantis leadership now is in Europe, even though it's a big 3 company. So it's all working well there. But I think the big issue is, can he repair the dealer relationships? The dealers are very upset with the past CEO Tavares about just sort of the moves he made, price changes he made. I think that's the big issue, is repairing that reputational damage. And also UAW, right? The workers were upset about what's happening in Belvidere, Illinois. Can he repair that? Can he get those factories online? We'll see. I don't know if it's a big ask, but as of right now, things are looking good for Veloso.
All right, we're going to continue to track that very closely. Pras, thanks so much for joining us, breaking down all things mobility. And when are you taking your cybercab ride?
If only they'll send me to Austin anytime soon, I'll gladly take one of these rides. I've done Waymo, by the way. It's great.
I'll send a Slack after the show. How about that? All your markets action ahead. Stay tuned. You're watching Catalysts. Now time for some of today's trending tickers. We are watching Supermicrocomputer, Advanced Micro Devices, also known as AMD, and Apple. First up, Supermicrocomputer stock sliding after announcing it plans to offer $2 billion in convertible senior notes due in 2030. Investors can potentially buy an extra $300 million in bonds within about 2 weeks of the offering, and some of the funds will be used to protect shareholders from stock dilution during the bond to share conversion. One Bloomberg analyst says that the offering is necessary to support growth and should provide a cash boost to help meet AI demand. Then you're taking a look at the movement of shares here. They're moving down in reaction by about 4.2%. But Jay, as we think about what this cash is needed for and what this essentially is trying to ensure among investors is that you have more longer term interest and participants who are looking to see where this cash infusion could ultimately help them in carrying out some of the scale that's necessary to continue to compete, especially within the demand profile that we've seen for chips right now, and how generative AI has been one of the core drivers of that addressable market.
Well, that's the hope, but right now investors have been punished owning this stock, and the ones that got in, remember when it was, a $200 billion market cap, it's at $25 billion right now. So while this could help over the near term and hopefully set them up for the long term, they've kind of been left behind in the dust, and there's just too much competition in the space where they've all of a sudden become the forgotten player in the space. So to me, this is good to straighten the bottom line, but technically, fundamentally, they still have a long way to go. So let's hope that this is another step in the right direction to get back to where they once were.
Yeah, absolutely. And especially how the allegations certainly did put a major dent in investor sentiment around this name, still essentially trying to win back perhaps some of that support as well, to your point here. Next up, we're tracking AMD, upgraded to buy from hold at Melius. The firm also raising its price target to $65 to $175. They've raised that price target, so it's now $175. Melius saying that AMD's development in AI accelerators and computing make it particularly attractive in terms of future growth. Additionally, the company is likely to benefit from most hyperscale cloud computing companies who want to build out artificial intelligence interfacing here. You're taking a look at shares of AMD right now higher by about 1.5%. Where does this sit within your broader evaluation of the chip landscape?
Well, this has been a laggard in the sector for a while. So to see that upgrade and to see that we've kind of put in a tradable bottom in the stock, to me is good. So I'm just going to look at this from a trade perspective, from a technical perspective, because I don't know the ins and outs, and I'm not going to profess I do compared to some of the other chip makers in the space. But technically, this just broke a long-term downtrend. Risk-reward setup is somewhere where you want to take a shot at this. As long as it stays above that 200-day moving average, around 125, I like it. It looks like it's going to have a little bit more room to run. The target price was about 165, I think you said. 160 looks like a good risk-reward setup with a 5 to 10 point downside. So to me, this is a tradable bottom, and the semi space is coming back. And there's one big semiconductor stock they've really taken them all to another level in NVIDIA if that breaks 150. So to me, I think this is a good place from a risk-reward setup to get into the name.
Yeah, one of the other notes within this note, or one of the comments within this note, our hunch is that we are in the middle of another move to the upside again as investors are about to envision even bigger GPU, graphics processing units, figures in 2026 through 2028. They're counting on a sustainable surge here in inferencing. We're investing in AMD's platform, seems to be more attractive for hyperscalers and sovereigns. We will see if that comes to fruition here. We got to talk one more name for you, though, and that is Apple. Apple potentially looking to make a bid to acquire Perplexity AI. This is according to a Bloomberg report. Perplexity, which was recently valued at $14 billion, would build out Apple's AI infrastructure, specifically an AI search engine. Now, these discussions are in the very early stages, we should note, and it's possible that discussions will not lead to any kind of offer here. And shares of Apple, they're moving lower by about 0.3%. We'll round that off to as of right now. As we're seeing this interest from Apple now to make sure that they don't miss out on what the next wave of search engines could look like powered by generative AI. What does that signal to you about Apple's interest in making its ecosystem even more sticky, and how that would read through to the investor thesis and how that could shift if this does go through?
Well, investors have been waiting for that next big thing from Apple for a long time.
But they've been looking on the hardware side.
And that's it. And this could be it. We didn't talk about Siri at the last WWDC. GTC event, which was 2 weeks ago. It kind of was forgotten, where a year ago, that's all they focused on was Siri. And now it's going to turn on as I say that. I apologize to everyone in the audience. But what is going to happen now is they need to kick the tires on this. And AI, Perplexity is a known, it's a big name. They have the cash on the sidelines to spend. It's time for them to step up and do something monumental. And if they're going to get into the AI space, this is a name you have to watch carefully. So it could just be talk for now, and I'm sure the price tag is going to be astronomical, but if anyone can afford to do it and anyone needs to change things up, it's Apple. So to have these discussions is a good first step. Let's see where it goes, but they need to shake things up because right now they're just surviving. They're thriving on their utility metrics and not in the innovation side of things. So let's see if this is a game changer for them. It hovers around 200. It's a nice, interesting level. Let's see if it can break it above.
Yeah, to your point, what is 13, $14 billion in terms of an acquisition when you typically tend to see Apple holding on to hundreds of billions of dollars in cash on hand here. We're going to continue to track all of those names here, and you can too by scanning the QR code on your screen to track all of Yahoo Finance's trending tickers throughout the session. We are 2 hours into the trading day here. Stocks rising as investors shrug off concerns of the escalating conflict in the Middle East. Joining us now to discuss today's investor playbook, we've got Lisa Schreiber, Gradient Investments investment analyst here. Great to have you here with us, Lisa. And we've got a few areas of the market that you're tracking that you want to run through here as well, and we want to discuss and break down. But first, let me just get your reaction to what you're seeing in the markets coming off of the events of this weekend and the escalation in the Middle East.
Yeah, it's very interesting, Brad, because we saw over the last couple of weeks the rising Iran-Israel escalations and now the U.S. joining over the weekend. What is really interesting to me, though, is that the markets and investors seem to take it at a stride so far, right, with markets actually up the first 2 hours of the trading day. And I think investors are able to look a little bit through that and focus more on energy prices and on a potential response from Iran that could potentially negatively impact global oil supply. So I think that's very interesting, and we see what the week will bring here.
We've seen a couple different, mind frames around picking petals over the course of the trading thesis this year. First, we started off with the U.S. exceptionalism trade, and then we saw the Fade America trade, and then we saw kind of just kind of pick if you want to be in international markets right now or if you want to buy back into the U.S. strength trade here. So where do you sit right now within that mix here, knowing that you could potentially see some headwinds for the international markets trade, especially in emerging markets, if we did see prolonged time in terms of some of the play out of these escalations?
Yeah, the interesting thing is when we moved into the year 2025, we called it the year of bring an umbrella, right? And we saw some downpouring this year where we needed an umbrella, right? When we look at what investors actually had to endure already, you named it, geopolitical unrest, we had some interest rate uncertainty, we have some trade and tariff chip chop. I think what it all tells us is that diversification really remains the name of the game for this year 2025. And like you also said it, when we look a little bit across borders, international markets really work well. Also, the US markets is actually positive year to date, given all the news and all the headlines that we see, which really helps investors zooming out a little bit, take a deep breath, focus on what's really important, their financial plan, their risk perspective, rather than getting caught up in headlines here.
Hey, Lisa, Jay Woods here on the set with Brad. You brought a few picks with you, and one of them is a pick that I've loved this year, Dollar General. It's up 50%. What does this tell you about the current tariff environment, and why do you consider it to still have substantial upside going forward?
Yeah, sure. So Dollar General, we really love this name at the moment. It was a beat on the top and bottom line in the earnings report. What was really actually more interesting than that is they raised actually sales and profit guidance for the full year, which is really interesting given that most of the retailers didn't receive a whole lot of investors' love because of the tariffs. And most of them actually were a little bit more conservative here, taking down guidance. Really, Dollar General is a bright spot here. Another interesting point here why we love the name so much, and I do not want to compare too much to Walmart, but just on this note here, they also start attracting higher income consumers, which is really interesting. And given a potential negative economic impact later this year, which really Dollar General could be a winner here. And you said it, this stock is up nearly 50% year to date. So it is not a secret anymore, but I think there's more room to run given its backdrop and its prospects.
Lisa, I want to take a look at one of the other names as well that could be a beneficiary that you're looking at in this market as well. It's Coca-Cola, and there's kind of a mix of things happening around there, but what is the kind of checklist that you look at to really go down the line with Coca-Cola to prove out the earnings thesis or the investment thesis there?
Yeah, again, same with Dollar General here, a high quality name. It's of Coca-Cola's industry. It's the largest bottler in the Latin American countries, right? Very strong in South and Middle America. And we saw that in the last earnings report. Mexico lagged a little bit, but the South American countries really stepped up here, which also shows the importance of regional diversification for this high quality name here. They're expanding their productions in some of the countries, which should increase efficiencies here. So it's really a great high quality name, like I said. And when we look at the valuation based on next 12-month PE ratio, then we saw based on its own history, it's actually below average. So I think it could really be a great name and a great time to step in here.
You know, I want to put a final question to both of you, Lisa and Jay, here, because we're going to get consumer confidence this week here. What do we need to see within that report to really gauge the thesis for a lot of the retail names, or even as we were mentioning Coca-Cola? I think about the number of different footprints that they're in, whether that is the consumer purchasing them in bulk at a Costco or purchasing them one-off from any type of, vending machine experience that they might have. But that means that there are more big partnerships that Coca-Cola is able to sell into. What do we need to see in terms of the consumer to really prove out where the rest of the retail landscape should be able to net out, and how investors should be kind of evaluating that pass through in the data? Lisa, I'll begin with you.
Mm-hmm. So I think, to your point, I think it's really important to focus on the dispersion between higher income consumer and lower income consumer, and how the higher income consumer maybe still is trading down, what we saw over the last couple of months. This has really remained the focus, or if they're also taking advantage of discounts and deals. So I think that the difference between higher income and lower income consumer is really the point to focus here.
Jay, I got 15 seconds here. What are we looking for in this report?
Yeah, we're looking for it to tick up. The prices of stocks are going up. Groceries have remained stable. So to me, it's more of a contrarian indicator, but it does go into the spending habits of the consumer. So that will be interesting to watch. And we've seen it in shops like Dollar General, where people are going for bargains.
Absolutely. All right, we're going to be watching closely for that report to cross this week and the investor read through. Lisa, thank you so much for joining us, as well as Jay, who's been with us throughout Market Catalyst. We appreciate the time. Coming up, we're taking a look at the latest moves in currency and what that means for investors on the other side of this short break.
With global tensions rising, there's a lot of chatter about the US dollar, which has been the world's reserve currency since just after World War II. And today we're going to look at exactly why currency and foreign exchange tickers can look so strange and what their charts are actually saying. I'm Jared Blickery, host of Stocks in Translation. Now here's something curious behind me. Check out these two charts from the past 5 years. Maybe we'll get to that in a second. We have the euro-dollar pair, whose symbol is EUR-USD equals X. There we go. And the US dollar index, that's DX-Y.NYV. These are a mouthful, but notice that they're mirror images of each other. The other one moves up, but the other moves down. So why do these symbols look so different, and what's the history here? To answer that, we need to define what the so-called Forex market is and take a quick trip back to the 1970s. So foreign exchange, or Forex, that is a 24-hour global marketplace where banks, businesses, and traders, they swap one currency for another. It sets the exchange rates affecting your vacation costs, import prices, even your investment returns. And it all started August 15th, 1971, when President Nixon closed the gold window, ending the era where foreign governments could convert dollars into gold. By 1973 on this timeline, this led to the collapse of the post-World War II Bretton Woods Agreement. And suddenly, exchange rates that they had been fixed, they were moving quite widely. So in 1976, the Jamaica Accords officially legalized and recognized floating currencies, which had already been trading somewhat freely for years. And in 1979, Europe launched its own monetary system to manage volatility. This led to the formal creation of the euro decades later in 1999. So those events shaped the modern Forex market that we see today. Now, what exactly should you know about Forex? First, every currency quote has two sides, the base currency first and the quote currency second. And which one comes first is simply a matter of convention that goes all the way back to the 1970s. Take the euro versus a dollar. Each currency in this pair always has three letters that do not change. So EUR is a euro and USD is a US dollar. Yahoo Finance also adds an equal sign and an X to the end. That highlights that these are Forex pairs. Now, the current price of the euro dollar is about 1.15. This means that 1 euro buys $1.15. And bottom line, the euro is just a little bit stronger than the dollar. Also, the smallest increment in Forex is just 1/10,000th of a unit, 0.0001. And this market never sleeps during the week. It runs nonstop from Sunday evening all the way to Friday afternoon. And some other fun facts. Forex is the biggest market on the planet with an eye-watering $7.5 trillion in daily turnover. Also, it's famous for high leverage. Traders will often borrow 30 to 100 times their money. This means that relatively small daily movements, they can have a huge ripple effect. And when they're big, watch out, because that volatility in currencies, it can quickly spill into the markets we know well, like bonds and stocks. And finally, the US dollar gets most of the action. It's on one side of 88% of all trades. The euro is second, appearing about a third of the time, and the yen is next with about 1/6 of the action. That was Forex. Now let's talk about the dollar index. What exactly index? The index part is key, and a currency index measures the overall strength of one currency against a weighted basket of others, so there are many. The most famous is the DXY, or the so-called Dixie, which you can see in this 5-year chart. Its weighting is determined by the euro with nearly 58%. That's why DXY mirrors the US dollar, the euro-US dollar Forex pair so closely, but upside down though. And here's a fun fact. The DXY basket has not been updated since the 1970s and is based on lightly traded futures contracts, which makes it a bit of an antique. And there are several alternative dollar indices, including some by the Federal Reserve, but despite this, the DXY remains an industry standard in an archaic relic that we still tend to use every day. And that's your currency crash course. Now you know why Forex matters and can look so strange even if you never place a single trade. And tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you. We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Buy now, pay later, or BNPL, could start to carry a bigger risk to your credit score. Fair Isaac Corporation, the maker of FICO scores, is rolling out a new credit model, including buy now, pay later loans for the first time. The new model would group these loans together when evaluating creditworthiness, and missing payments would likely hurt your credit score. Up until now, these loans haven't been included in FICO scores, and the credit agencies have struggled to figure out how to measure them, but they're growing fast. BNPL transactions are expected to reach $108 billion in 2025, according to eMarketer. And some experts worry that this could signal financial strain for some consumers. Some providers are already getting on board. A firm announced in April that it will report all new loans to Experian, and others are expected to follow. The new credit model won't replace the current one, but will be offered alongside of it, giving lenders more options to evaluate borrowers. But it's up to the major credit bureaus, Experian, Equifax, and TransUnion, to decide if they'll make it available to lenders here. So as we're thinking through this, here to close out the hour and with me for some final thoughts on that and anywhere we would like to take that conversation as well, because it really is a read on the consumer. Yeah. And if we think through to some of even the New York Fed data that looks across where debt is being held among consumers and credit and the record high levels of credit that we've seen households take on, there, of course, is the thought process of how different purchasing mechanisms have actually been lighter fluid for some of the credit that we've seen consumers need to tap, especially if there are households that are more stressed on the cash front.
Well, it's record credit levels, but not compared to overall savings. So those numbers are high, but they're not panic-stricken levels where it's really impacting the market. But I like what's going on here. As somebody, a boomer like myself, who has tried to pay down his debt and is worried about his credit score, if you have that alternative, which is a good alternative, the buy now, pay later, I've tried it. We talked about it before we jumped on this segment. But a nice little rowing machine. Let's try 4 payments of $300.
Which back in the day, for a lot of people that were doing a lot of the home shopping, because I used to work for QVC as an intern when I was in high school, it was just 4 easy payments that you were breaking that out on. So essentially, this is that model, but at scale for any type of retailer that will partner with the Afterpays, the Affirms, the Klarnas of the world here too.
But if you're delinquent on these payments,
that's the key.
Lenders need to know this, because if you're going for that car, that bigger purchase, the house, the Equifaxes of the world, which, probably a safer play from a long-term point of view, they need to keep on top of this, because if this mentality, buy now, pay later, and then we're delinquent on it, isn't kept in check, it could have ramifications down the road. Now, yes, this is hello boomer coming at you again, trying to be responsible. But the buy now, pay later stocks, they had their run and they're finally coming back. I look at Affirm, I look at the chart, it looks pretty good to me, but it still has a long way to go. It is up 100%, so it's seen the worst of times and it's slowly coming back. PayPal is struggling, but it's up over the last 52 weeks. They're just not the high flyers they once were, and this regulation could be looked upon as a stumbling block, but to me, it's more giving it legitimacy, and it will avoid some of the shenanigans you see where people are delinquent on their payments.
Absolutely. We're going to be watching this closely here as we move forward. Jay, you've been kind enough to take some time with us, a good bit of time here with us over the course of the day. We appreciate it. That is it for Market Catalyst, everyone. I'm Brad Smith. Thank you for watching. We've got more Yahoo Finance straight ahead.